just saw in my presentation that this year funding will be down a lot relatively, certainly to these last 2 years, but even in the past 8 years or so. I'm going to try to put that slide up on the screen showing the possible correlation between interest rates and funding. So my first question to you is, do you agree that the boom is dead as long as interest rates are high? Is it more so a residual effect of inflated valuations, or what are the other factors at play here? Amy, we could start with you.
Sure. Well, I mean, our perspective is more from the CVC industry as opposed to the general kind of venture, financial venture funds. And what we have seen over the last couple of years is that there are more corporate venture capital firms than ever, right? Every year it has grown in the last couple of years. Lots of funds being deployed. We certainly have been very, very active. So it doesn't feel like the boom is dead to me, but certainly there's definitely, it depends on where you are within the industry, within the investing industry, because, corporates might have more funds to deploy or maybe be a little bit less concerned about the current environment because they have funds to deploy, and it's more about finding strategic value for their corporate partners or their corporate entities. And so from my perspective, we've seen a lot of CVC activity, and I think it's continuing to grow. It'll be interesting to see what the numbers come out kind of towards the end of the year to see if that's starting to tail off, but it hasn't in the last 2 years. It's been very, very strong. So I don't know that the boom is dead, but for us, it's always cyclical and it comes and goes, but it's been a fairly strong time for us, at least.
Okay, it's not dead for you?
Not dead for me.
I think the party is over, that's all. So,
dead for you.
So we want to still keep going, but I think underlying stuff, if you look at it, I think it was just euphoria that we had with all the free capital. And I think you're still continuing to see good companies getting funded, but we saw in your presentation that the debt funding being very, very small.
This year,
you can imagine following the growth of public markets, then private markets, it's like mob mentality going down the stream. And if you look at debt, that's a big factor too, because a lot of PE firms use debt to fund companies and to improve their outcomes, right? But even if you take a company that is valued at 100 million growing to 500 million over 5 years at a 40% growth rate, if you take 50% debt just for the sake of it, with debt, that return could be 9.2 at 5%. At 15%, it's 8.6. It's really not that different. But this mentality has changed because of valuations coming down, and they're saying, can we get the same level of valuations instead of a 10x, will we get 8 or 7? So that's what I think has happened. And last point on this is the dry powder. We're sitting on $300 billion today versus around 175 in 2020. So you can imagine how much money is sitting on the sidelines.
So what are they waiting for?
For the party to start. I think public valuations, all of that will start.
Everything to kind of normalize.
Yeah, and maybe to add to that, I think I had a similar feeling. The boom is not dead, but I think craziness is dead. And to KJ's point, I think, yes, some of the numbers are skewed because we haven't seen the debt plays, we haven't seen the insider rounds in those numbers, we haven't seen the kind of convertible and structures that are all in those numbers, but just not announced. So I think that's skewing a bit the data. I think the second piece, the boom is not dead, but I think the use of proceeds is going to be a lot more specific and the type of, and I specify myself more on the later stage growth rounds. And I think those rounds, you probably won't use this just to kind of pure fuel growth. Like we're seeing a lot of M&A proceeds being used around those like new rounds coming up. A lot of secondary are happening as well. So I think like because valuations are aligned now with investors and entrepreneurs, we're going to be a lot seeing like you're raising this round because this is what we wanted to use it for.
Yeah, I would agree that we've seen a ton of insider rounds and a ton of convertible note rounds. Like it feels like people are, came off of a round that was a higher valuation, don't want to really raise in this environment, so they do a convertible note round, and that maybe not is reflected in the numbers.
That's a really good point. Yeah, we're going to track things that are announced, that are public.
Yeah, exactly.
So there's probably so much more internal rounds going on. How much does travel demand factor in here? We're hearing a little bit about softening demand going forward. So, how much do investors really look at that or are concerned about demand softening, when looking at an investment? I know you're looking at a 10-year horizon and the travel industry will always bounce back no matter what happens. But
Like maybe a quick story. Like in April 2020, I was invited by my investment committee to present Hopper and Sonder, what both companies have zero revenue for I don't know how long. And let's say it was probably one of the most interesting investment committees I've done in my career in investment. But I think like you need to believe that travel is there to stay. Yes, there's going to be changes. Yes, there's going to be disruptions. But are you backing the players that are either going to consolidate or disrupt in your investment thesis? And that's what we've been focused on. And maybe it's actually a good opportunity if you can see the kind of long-term play to make some of those bets.
Mm-hmm. We have another slide up on the screen related from my presentation. So this was our data showing there were 86 acquisitions globally in travel in 2022. It was almost double prior years. And I noted this was because as funding started tightening and valuations started falling, more companies needed exits. So do you agree with this? And maybe more importantly, where do you think we are in terms of valuations normalizing?
Well, I mean, I think valuations have definitely come down and have more normalized. I mean, I wouldn't say that this is like, a tragic fall. I think it's a more normalization, right? Some of the valuations we saw in 2021 were just super inflated in 2022. As far as the M&A, I mean, our portfolio, I can only speak from, what I see kind of on a day-to-day basis. A number of our companies have purchased competitors to grow during this period of time. A number of our companies have been are in the process of maybe being purchased by others for the same reason. So I think that there's definitely quite a bit of that activity going on. And one of the things we're seeing, and one of the conversations we're having is, when our founders are looking at, their high valuation from their last round, kind of a little bit more of a compressed market, but needing to raise, there's two questions. Do they raise a note round? Do they raise an insider round? Do they look for M&A opportunities? And yeah, the question is, the answer is yes, they are looking for those opportunities. So we are seeing some of that, but, probably equally as much we see the insider note round kind of be the answer instead.
Yeah, we're doing a lot of acquisitions across our platform companies. I think one has actually acquired 2 already this year, looking at a third, and these are sizable acquisitions, $40, $50 million acquisitions in the larger platforms. I think it's clear if you have a go-to-market machine in one of the companies and the others has a product that can add on to it, and if you're getting valued at 8 to 10x and you see a company that's sitting there languishing because of no growth and no marketing, but if you can take that and drive a 40 to 50% growth rate, it's accretive for the overall company. So that's one way to build value because overall valuations have come down, but using an M&A strategy, you can get to that almost close to it with a sound M&A strategy, and valuations definitely have come out. And some companies are going to run out of money. It's just pure and simple. And rather be part of a bigger group and keep it going and survive.
I was actually surprised with the 2022 stats. I had no idea. And maybe because our portfolio hasn't done it that much, but I do think, and quote me or don't quote me, but 2024 and 2025, I think we'll see a higher number of those because I do think like the way I see the world is 2022 and 2023, consolidators, they all kind of like, strengthening their own fundamentals before thinking about accelerating with M&A. And now we're seeing kind of like the end of this, the balance sheet are robust, and now is the time to kind of push on that opportunity. On the target side, I think this is where companies like 2023 was a reset year, and now beyond just valuation, they probably have a much clearer picture on what's their true positioning in the market. And then to see, to your point, if we still have cash and there's like a more strategic ROI to kind of partner up with someone, this is the right time to do it right now. So I do think, I don't know about the situation in 2022, but I do think that 2024 and 2025 are going to be hyper active on that front.
I think you should quote her because she's going to be correct. Seriously.
On Phocuswright, we'll do.
Yeah, listen up.
Just really quick, do you feel like valuations are where they should be now? Others are a little bit more ways to go, like through the next year? That's okay.
Well, listen, we're investors, so obviously, we're gonna.
Oh yeah, we want them to go down further. They clearly are going down now.
But realistically, I think, at least I'm going to talk more about the growth perspective, and I think it's slightly probably different on the early stage perspective, but like the first half of the year was pretty quiet. Second half of the year, a lot more active, but I do think actionability on what we're looking at right now is going to happen in the first half of next year, because so I do think there's probably another kind of 6 to 12 months to have that more like real historical stabilization.
I mean, it's a tricky thing because I joke, but really, if we're already in the company, we want the valuations to go up. If we want to get into a new company, we want them to go down. So it's a tough balance.
I think we want valuations to go up because we need to sell. I'm just kidding, but
See, there's both sides.
there's if you look at the top decile valuation change from 2022, you're talking about 13 to 14x coming down to 8x.
Yeah.
That's not warranted because of interest rates moving from zero to where they are today. Even if you get interest rates at 15 to 20%, you can still make a lot of a pretty good return with good companies. And I think that's the key, is getting more debt, all of that thawing together. The other important thing is, I think it's critical for companies to be looking at some certain metrics, not just growth at all costs, but profitable growth. Those are the companies that get funded, Rule of 40, growing with little burn or relative burn, but a higher growth rate. So I think those are all critical components in valuation that's going to make a difference. So.
All right, thank you for that. I want to move to one specific question for each of you. We'll start with Amy. So given JetBlue Ventures' focus on sustainability, how do you think about ROI in that context? Seems like there's a balance you need to strike between kind of doing the right thing and maximizing ROI.
So we do spend quite a bit of time looking at sustainability companies, and we've invested in, 11 to date with another 3 kind of in adjacent tech. But we've invested in 53 companies so far, or 52, I think it is. 53 soon to be. I'm counting my chickens before they hatch. But no, we balance this out, right? Like our entire portfolio is balanced. Some of the things that we do are very long term, and a lot of those are our climate tech investments. Because the way we think about it is, we're here to supplement the work that JetBlue is doing today on reaching their net carbon zero goals. And so they're doing all of the things that are going to be from now, call it to 5 years, and we're looking at tech that is 5 to 10 years out. And yes, the ROI is a much longer time horizon for that stuff. But that balance is balanced out by the rest of our portfolio, a lot of which is much more nearer term. So that's how we think about it. We don't think about just that one category and kind of the return that we're going to get on that one category. We're here to, that category is about long-term, long-term helping JetBlue kind of reach their goals in 10-ish years. And we balance that out with other parts of our portfolio that are much more nearer term. We have 5 themes, and that's just one of them. So that's how we think about it. So we don't get hung up on the fact that some of the things we're investing in, really aren't going to come to fruition for, 5, 7, 10, 15 years, because we have things that are very real, near-term 1, 2, 3-year exits. So it all balances out.
Yeah, so some of that is very strategic.
Yeah, so some of it is a little bit more strategic. I mean, I think they're going to be great financial plays as well. It just is longer term, right?
Great if it's both, sure.
Yeah.
Okay, Mia, so Inovia has invested in Sonder and Hopper. They're both under some pressure lately, so what is your take on each company's current status and future?
For sure. Let's maybe just take a step back, because I do think our investment thesis for both of those companies still holds. I mentioned a bit earlier, but the Inovia thesis in the hospitality space is either we back consolidators or disruptors. You think of Sonder, they were able to consolidate a pretty differentiated supply in the short-term rental space, and they're the only player standing right now. Hopper, they were able to disrupt the whole OTA space with their new fintech offering, their white label for corporations, and they again disrupted that segment. Both companies, they know market expectations today, and they know companies that don't have a clear path to profitability, to your point on unit economics, will get penalized on discounts and pricing, and that's what happened with Sonder. Francis knows exactly what he needs to do. Earnings, I think, are in 30 minutes, so we'll know more. On Hopper, I think the company is actually pretty well positioned. They have a very unique, agile organization structure. They have a CapEx light model, obviously, as well. And if you know Fred, he's pretty efficient to put changes in. So, a few weeks ago, they announced the right size of the company to really focus on the core activities. They announced on their doubling down on their direct relationship with suppliers. They're really doing all the right things to have a successful outcome in the medium term. So, still holds.
Okay. And then KJ, you lead HTV, Highgate Tech Ventures, which primarily invests in hospitality and travel tech. So broad question for you, try to answer somewhat succinctly. We have 9 minutes left. What's the status of hospitality tech at this point in your mind, and where are the biggest investment opportunities going forward?
Broken. So that's
agree.
the status. So,
A lot of us would.
so I mean, it's two things. One is you can also look at it as the opportunity. I think everybody complains in hospitality, like we're not like the airlines and we're not the same. Obviously you're not, you're fragmented. It's clear. I mean, the only other fragmented thing is the short-term rental, which is even more fragmented than that. So the status is the way we see it is there are going to be a couple of platform businesses that do more over time, but you can't get in with a solution that does right from like building up as a startup, building up distribution, CRM, pricing, revenue management all together. But I think you're going to start seeing a consolidation because the industry needs it. You would be surprised to see various functions, be it the front of the house or commercial functions, the back of the house, the number of systems that they have to go in, a messaging system, a PMS system, a scheduling system, like just the back office, the pricing, revenue management systems, plus a BI system, plus data somewhere else. I think that consolidation is going to happen, and you're going to see a lot of this in the future, and that's what we're looking for. One is with the companies that we have, can we acquire other companies to enhance the offering? At the same time, looking at what companies can actually use some of these modern technologies to help build efficiency in hotels.
Okay, thanks. Could go for a while on that.
Yeah, I'll stop.
But staying on tech, let's move to generative AI. So we noted that travel funding is down a lot, but could the interest in generative AI help to spark a new investment cycle and help funding recover? And as part of that question, how much does generative AI really matter to you versus AI as a whole?
Well, we've done investments, I think we're up to 12 companies that use AI and have been using AI, but most of it is predictive AI against data sets, right? Mm-hmm. We have one really great company that has been using generative AI to do kind of advanced fraud detection for a long time now. And other than that, we haven't really found kind of what we think is the right use case for generative AI, like a company for us to really kind of wrap ourselves around and actually invest in. But AI in general, I mean, we are very keen on finding companies that use AI against, really the massive amounts of data that we have in the industry for operational efficiency and things like that. And we've been looking at that for a really long time and have several really great companies in our portfolio in that space. Generative AI, I'm sure there's a really interesting, keen, fun thing that I'm not sure about the trip planning. I see the thing up here. I mean, there's a lot of trip planning out there, and yes, generative AI could be used for trip planning, but I'm just skeptical that that's going to be the thing. But hopefully we'll find, a couple really great use cases that we are really excited and passionate about.
Okay, other perspectives?
Yeah, I think the difference between AI and generative AI is obviously the AI part. You can pre-process certain steps and predict stuff, but generative AI is all about creating new content using the models, right? So I think this is going to be the number one thing is all about content creation, which is going to be useful. Whether you like it or not, you're going to start seeing a lot of generative AI content from hotels, whether it be on social, whether it be on the web. And Google's also going to start looking at some of this stuff too. And then it's a match, like what's the good and what's the bad. That's going to happen, but I think that's a big use case. We have AI in companies that we have already invested in, but generative AI, we're looking for companies that will take this to a whole new level, especially on the content creation piece we feel is a big thing there.
Mm-hmm. Maybe just to add up, I do think content like trip planning, customer support automation, marketing automation, those will all become table stakes pretty quickly. And what I'm excited to see, I don't know yet if it's going to be generative AI or AI, but the use cases that will be able to really focus on the real needs problems right now, like imagine like labor shortage, solving kind of like staffing on airlines, like housekeeping in the hotels, travel disruptions. Like those are the use cases that I think if you're able to kind of show a measurable outcome and have a proper set of data, that could be super exciting. But to your point, we haven't seen it yet, but I'd love to see it in the next wave of those applications.
We're seeing it in call center AI, actually. You can actually take a call through it. So 40% of calls can be taken by that, but you can expand it to 60, 70 over time. That's a huge move there.
Yeah, and one of the companies we've invested in is using AI for that exact reason. And that's a great use case.
Yeah.
Is it, something so compelling that it's going to be the winner? I just don't know. And you're right, content creation, but I don't know. We just haven't found what we think is
I mean, the Beatles
the
have
big
released
win.
Now and Then, which is the latest thing based on AI. They brought Lennon's voice back, right? So,
Yeah.
so we should be doing it.
Yeah, right.
How about the idea that companies that kind of build from the ground up and are generative AI native, from their tech stacks to their call centers and how they optimize everything, will they have significant advantages versus incumbents, legacy companies that can't change their processes and can't change their technology and adapt all that quickly?
I think any company that has data
Yeah.
is going to use it. If
Exactly.
you
Yeah,
go
with
after a
the-
company that's
yeah,
AI
it's at the
focused
bigger
without the
advantage.
data, then it's empty. But if you go after a company which gets the data, can build on that massive amounts of data, then the AI on top of that, if you get good people, you can do it.
But a lot of startups right now are in this space where they're like, oh, how do we be an AI company? We want to jump on this trend, and we want to be an AI company. It's going to help us fundraise. Not every company is an AI company. You may use AI for automation, for marketing and content, and things like that, but that doesn't mean you're an AI company, and not everybody should be, right? So I think that's kind of the weird
They want your
thing.
money.
Yes, they want our money, right? That's going to be the way it's going to shake out. Is like, a lot of our portfolio is that how do we become an AI company? I'm like, you're not an AI company.
But I think
you
that's
use
a key
AI.
point, because I think it's like having a defensive strategy with AI, making sure you're on top of it on the back end, at least you're kind of being smart about it. Offensive, I agree. Like on the customer front, I think it really depends on what are you exactly trying to solve.
Yeah.
So that's what we've been constantly with companies as well.
Yeah, totally. You've got to have a real use case that actually uses AI for a real reason to say you're, kind of an AI-driven company, maybe.
Absolutely. We have about 2 minutes left. Can any of you talk about companies that are not in your portfolio that you do have your eye on? Or if you don't really want to go there, what companies do you regret missing out on investing in, and why?
Well, I'll really quickly, speaking about AI, I would love to see a really great predictive maintenance company. I know that's very aviation specific, but it's a really great opportunity, and we have looked at a lot of them, and there are some really interesting ones we're tracking, but we haven't found it yet.
If parts are going to break.
Yeah, well, just understanding kind of the maintenance cycles, getting ahead of breakage, getting ahead of things that need to be replaced in advance so that you're not, caught in really bad situations. There's lots of opportunity there.
I think we did look at Hopper in 2017, but if she said it's 0 in 2020, I wonder what it was in 17. So we probably passed on that. It looks like it's doing well, hopefully, and I think, but he's got a lot of navigation to do. It's a tough market, but I'm not sure if that's a pass that we did, but
I think they're going to do well.
Yeah, that's it. So.
And I think on our side, I'll flip the question slightly, because I was debriefing this internally. We discussed about exit. I think one, it's called Luxury Retreat, which we actually invested and sold to Airbnb. So I think first we sold too soon and for cash versus stock. So it was a good outcome, but I think we could have a great outcome. So I think strategizing about what makes sense on optionality is a key point here. Yeah.
Okay.
I think if F Prime lets me invest, we can actually do a lot better. So.
I'm sure. So just really quick then, 30 seconds left. Advice for entrepreneurs, about how to just navigate the next few years in terms of a difficult fundraising environment and potentially softening demand in travel.
Well, some summary points. I think cash is king, and don't wait. We hate to see a company that has less than 12 months of cash runway when they approach us. So think about that. Focus on the right partner versus the right valuation. And think strategically of what's your competitive, what's your long-term moat to make sure you're strategizing on what makes more sense in terms of strategic partner going forward. So those would be my advice on the fundraising side.
Totally agree. Focus on the cash, make sure you don't run out of money. Execution right now. That's all that matters. And go for the metrics that you want to get to, maybe even if it's 12, 18, 24 months from now, at which point you might have to raise.
All of that, I totally agree with. And then just be creative about how you're thinking about raising funds right now. You know, insider rounds, note rounds, you know, some of those opportunities are really good opportunities, and maybe it's not the time to do a price round with a really big valuation hit. You know, do a note round, you know, that maybe it's a, you know, kind of a flat round, so to speak, that gets you kind of through. So be creative about how you're thinking about your funds. Definitely don't wait.
Okay.
Or get a strategic in and drive revenue.
Yeah, but get creative or cash is king.
Cash is king.
Yeah.
Amy, KJ, Mia, thank you very much.
Thank you.
Thank you.